Welcome to PIMCO Pod. In this episode, we discuss how in a world of high starting yields and rupturing economic alliances, investors who actively diversify across regions, sectors, and currencies can be better positioned to pursue durable returns. Global Bond Diversification, Higher Yields and New Opportunities for Alpha, by Andrew Balls and Pramod Dewan. Key takeaways. Elevated starting yields can help anchor the return outlook. Attractive bond yields across developed and emerging markets establish a baseline for fixed income beta, meaning returns driven mainly by overall market performance, while a globally diversified bond allocation may provide compelling returns for the level of risk taken. Economic paths are diverging across countries and sectors. Structural shifts in AI investment, energy markets, and fiscal policy are creating more persistent differentiation between winners and losers across regions and assets. A wider spread of outcomes creates more potential opportunities for active managers to add value. In a rupturing world, flexible strategies can pursue more opportunities for alpha, meaning returns generated through active decisions than static, index-based approaches. The reset in global bond yields in the early 2020s established a foundation for the return fixed income investors can earn just from being exposed to the broader market. Starting yields, historically highly correlated with 5-year forward returns, are now at levels that simply weren't available for most of the prior decade. This means investors can once again look to bonds as a potential return-generating asset class, not only as a defensive allocation, but yield is only the starting point. The central question for investors today is what that yield exposure should look like. Increasingly, the answer may point to a global bond allocation across both developed, DM, and emerging markets, EM. As geopolitical fragmentation reshapes trade, policy, and capital flows, dispersion across countries and markets is widening, meaning outcomes for growth, inflation, and interest rates are diverging more across regions. For more, see our latest secular outlook, Rupture and Resilience. Divergent economic paths are producing greater variation across countries, currencies, and credit markets. In effect, expanding the opportunity set for active managers to pursue returns beyond what that broader market can offer. The result is a rare alignment, a strong global starting yield foundation to support broader market returns, beta, paired with opportunistic conditions for returns driven by active investment decisions, alpha. Why global beta is attractive beta? A fixed income allocation built solely from the traditional building blocks of certain DM bonds, investment-grade credit, high-yield securitized assets, can constrain return potential by limiting the opportunity set. A genuinely global allocation works differently. By investing across DM and EM, investors can often benefit from today's more attractive starting yield levels in a variety of markets. Incorporating sovereign debt and local rates across DM and EM may help expand return potential, improve resilience across macro environments, and support performance potential relative to risk. The reason is embedded diversification. Bonds across DM and EM local markets generally respond to different drivers, distinct rate cycles, divergent fiscal trajectories, differentiated currency dynamics. Owning that breadth itself is a potential source of return because it has the ability to harvest risk premia that a narrower allocation structurally cannot access, while also helping support risk mitigation. Today, for example, we believe EM economies warrant renewed attention. EM balance sheets have been relatively conservative and look strong from a fiscal standpoint. EM inflation, even excluding China, is now lower than U.S. inflation for the first time in recorded history, a reflection of hawkish, credible central banks that hiked rates aggressively and are cutting slowly. Real, inflation-adjusted yields remain elevated relative to DM, which has created a persistent valuation advantage. Portfolios that exclude EM local exposure are forgoing a significant share of the global fixed income opportunity at a time when its diversification properties appear most attractive. A macro lens, AI, energy, and structural dispersion. The case for global bond allocations rests largely on diversification. What we see changing today and strengthening that case is the rise in structural dispersion across countries and markets amid persistent differences in growth, inflation, and capital flows. The global economy is being reorganized today along two powerful structural vectors: a headwind from reconfigured energy markets and a tailwind from AI-driven investment. Crucially, these forces are asymmetric, creating winners and losers across both DM and EM. In DM, the US has benefited from AI exposure and relative energy independence, while Europe, the UK, and Japan face the opposite combination. Across EM, the dispersion is equally sharp. Korea and Taiwan sit in the AI beneficiary quadrant despite energy vulnerability. Brazil and the Gulf states have benefited from commodity exposure. Others face headwinds in both dimensions. In this environment, a global allocation can pursue superior outcomes. When every market faces the same forces and effects, there is less to differentiate. When those forces are asymmetric, as they are today, the breadth of available opportunities can be a primary performance driver. From beta to alpha, active management in a divergent world. These same forces are widening the gap between active and passive outcomes. Divergent monetary policy paths, fiscal dynamics, and structural exposures to AI and energy are expanding the range of outcomes across rates, credit, and currencies, creating inefficiencies that skilled managers can look to exploit. Rate cycle divergence across DM and EM, structural shifts in terms of trade between energy importers and exporters, and the uneven impact of AI-driven capital spending are all creating pricing gaps that a domestic or regional allocation cannot access. Managers with the flexibility to allocate globally, positioning across rate cycles and expressing relative value across yield curves and currencies, can pursue compounded excess returns over a full cycle. Alpha generation in this environment entails identifying durable inefficiencies, such as the yield premium in EM economies where hawkish central banks have moved ahead of the Fed, or mispriced credit in sectors being reshaped by AI capital spending. It also means building portfolios for resilience, with an explicit focus on downside risk and low correlations, and letting valuation guide decisions across sectors, regions, and asset types. In a more fragmented and uncertain world, static index exposures appear less equipped to navigate divergence, while active strategies can allocate dynamically across countries, sectors, and instruments. This is less about short-term positioning and more about secular opportunity. In an environment of persistent dispersion, earning a premium for complexity, maintaining discipline as spreads evolve, and preserving liquidity for future opportunities can lay the foundation for durable excess return. Thank you for listening. That was Global Bond Diversification, Higher Yields and New Opportunities for Alpha. For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.